Hello, everybody. This is Kevin Shortell. A lot's changed with technology over the last several years, both in the public markets, the stock markets, as well as the private markets. In the public markets, for example, there's a lot of platforms now that people are utilizing, such as index funds. They're getting away from managed funds because it's too expensive, and they realize, hey, these index funds are going to be better than trying to beat the marketplace. In the in the private sector, crowdfunding has become a big deal, especially in real estate, which is my specialty. And crowdfunding enables people to buy properties by getting loans. It allows other people to participate in buying property. But when it comes to hard money loans, where are we today? Is crowdfunding a good way to do that as an investment, or should you do your own hard money loans? And that's what this quick video is all about here. In the private market changes, again, you can jump online and see all kinds of information about crowdfunding companies, and they started around 2012, and over $2.5 billion was put in by 2015. These are some of the top 10 according to, again, various sources, very popular crowdfunding platforms in today's world. Arrival of crowdfunding after the Jobs Act of 2012, and is it time, though, to take a second look at that, or a stronger look at that? Since these companies have been around, real estate's been doing pretty well. And one of the things is accredited investors can only participate in most of these companies. There are some type of crowdfunding platforms, but they're done through REITs for non-accredited investor, and they're actually higher risk, by the way. Accredited investors have a bunch more options to do, including the list that you just saw there. But some of these companies also can utilize bank loans and venture capital for further leveraging. And that could be causing a problem because as recently as just a couple days ago, one of the biggest, one of the most popular, one of the early starters in the crowdfunding space, Realty Shares, is in big time trouble. They're no longer taking on any more investments. In fact, word has it that they're even outsourcing the management of the investments that they do have. They're pretty much done. They couldn't find buyers, they couldn't find more investment capital, and couldn't make their business scalable enough to work out. And that's really concerning for a lot of investors and a lot of people in that industry there, because what's going to happen? And you can see there are many people that think there's going to be a shakeout. There's going to be some business models that work. There's going to be some business models that don't work within that sector. And it's very important, if you're investing that way, to do hard money loans, that you really understand what it is that they do and if they are mitigating their risk. When it comes to doing private hard money loans, like all hard money loans, really, in theory, you are in the safest part of everything because you're in the safest part of the capital stack. And what that means is if you've got a property that has $100,000 in value and you're lending $70,000 in value, you've created what's called an equity cushion within there. That investor, that other investor that you lent money to, has some skin in the game, and that lowers your risk, making it a much safer place to be. The higher risk in this capital stack is in that equity, because when you think about it, there's essentially two outcomes on this one. You're paid back upon sale or refinance. So this investor, when they sell the property, they'll make whatever profit margin they make after they pay back you, plus your interest, plus they have their expenses, their overhead and such. So they're in a riskier position as to how much they can make on there, especially if things go wrong. Because if things go wrong, what happens? The debt holder, which is you, the hard money lender, you take the property back if you're not paid. That's what makes it riskier in this transaction here. So private hard money loans, it's also important to mitigate your risk. And that's something that if you're looking through those those crowdfunding platforms, you really have to go through their paperwork and see what they are doing in three major areas. Asset class. Obviously, if you're doing your own private hard money loans, you can choose the asset class that you're going to invest in. Is that going to be single family homes? Is it going to be commercial? Is it going to be land, industrial? You name it there. Judicial or non-judicial states by location. Maybe you want to do hard money loans in short-term foreclosure states like Georgia, Missouri, states like that, where if you do have to take the property back much quicker than New York or Florida in longer judicial states. You also want to look at the strategic strategic rules? What's the maximum loan to value ratio you're willing to do? Are you comparing the value of the property or estimating the value of property as is or after repaired value? So you set guidelines as to lower your risk and maximize your profits. Me personally, I think the best way to do private hard money loans is to do individual loans yourself or with some financial partners on a grassroots level. It gives you much more control. And once you understand how to do that, it doesn't take a whole lot to market, number one, because there's always people looking for money. And number two, it doesn't take a whole lot of time to evaluate a deal and decide if it fits within your strategic rules or not. Hope you enjoyed this short video. Look forward to putting another one together for you soon.